Are you ready for a change that could shrink your paycheck? Starting in 2026, a significant shift in Social Security payroll taxes might leave some workers feeling the pinch. But here's the kicker. It only affects a small percentage of earners. And for those who hit the new cap, there's a silver lining. Let's break it down in a way that's easy to understand, even if you're new to the world of payroll taxes. Next year, the maximum earnings subject to Social Security payroll taxes will jump to $184,500, up from $176,100 in 2025. This figure, known as the wage base, is adjusted annually based on the National Average Wage Index. While this change might seem minor, it's part of a larger conversation about the future of Social Security funding. And this is the part most people miss. Only about 6% of workers earn enough to be affected by this cap, according to 2024 data from the Social Security Administration, SSA. The SSA announced this update alongside a 2.8% cost of living adjustment for 2026, which was delayed due to the federal government shutdown. But why does this matter? For high earners, crossing this threshold means paying more in payroll taxes, up to $11,439 in 2026, compared to roughly $10,918 in 2025. However, there's a trade-off. Hitting the cap can maximize your retirement benefits, as the SSA uses your 35 highest earning years to calculate your payouts. But here's where it gets controversial. Some argue that raising the taxable maximum is a band-aid solution for Social Security's looming trust fund shortfall. Others believe it's a fair way to ensure higher earners contribute more to the system. What do you think? Is this a step in the right direction? Or does it place too much burden on a small group of workers? Financial planner Catherine Valega advises her clients to aim for the wage base annually, if possible. For business owners tempted to structure their taxes as an S-corp to avoid self-employment taxes, she warns that this could reduce their retirement benefits. Similarly, individuals who take time off from work, often women for caretaking duties, may see their benefits shrink later in life. Valega's message is clear. Everyone should be thinking about Social Security, not just those nearing retirement age, because by then, it's too late to make a difference. Here's how the taxes break down. Employees and employers each pay 6.2% of wages up to the cap, totaling 12.4%. Self-employed individuals pay the full 12.4% themselves. Additionally, all workers pay Medicare taxes, 1.45% each for employees and employers, or 2.9% for the self-employed, with no earnings limit. High earners, over $200,000 for individuals, $250,000 for couples, also face an extra 0.9% Medicare tax. So, what's the takeaway? While the 2026 payroll tax cap may seem like a minor adjustment, it's part of a larger debate about Social Security's future. Is this a fair way to address funding gaps, or does it unfairly target high earners? Let us know your thoughts in the comments. We'd love to hear your perspective.